Welcome to this video on stock investing for beginners. In this video, we'll cover the basics of the stock market and provide tips and strategies for getting started with investing in stocks. Even if you're a complete beginner or you don't have much money to invest, make sure you stay to the end, as there will be lots of great ideas to get you started on your journey to financial freedom. If you like this content, please remember to hit the like button and subscribe. Let's get started. First, it's important to understand what the stock market is and how it works. The stock market is a marketplace where publicly traded companies can raise capital by issuing shares of stock. These shares represent ownership in the company and can be bought and sold on the stock market. When you buy a share of stock, you're essentially buying a small piece of ownership in that company. You become a shareholder of the company and are entitled to a portion of its profits and net assets, as well as the right to vote on certain company matters. Now let's say you buy one share of Apple stock. You are now part owner of Apple Inc. You are a very small owner of Apple, but you are technically part owner. The more shares you accumulate, the larger percentage owner you become. The price of the shares is determined by supply and demand. Buyers enter a bid price to buy a parcel of shares, and sellers enter an offer price to sell a parcel of shares. When the buy and sell amounts are equal, a trade is executed, and this becomes the new market price. Prices fluctuate throughout the trading day as news is released about the sector a stock is in, as well as general economic conditions. Prices move over longer periods of time based on a company's financial performance. The most well-known stock exchanges in the world are the New York Stock Exchange and the Nasdaq. Stock indexes such as the S&P 500 track the performance of a group of companies. The movement of these indexes can provide an overall sense of the health of the stock market. Okay, let's now look at how you can profit from stocks. There are two main ways in which you can profit from stocks. 1. Capital appreciation. When the value of a stock increases, investors can sell their shares at a higher price than they originally paid, resulting in a profit. 2. Dividend income. Some companies pay dividends to shareholders on a regular basis, which can provide a source of income for investors. Before you start investing in stocks, it's important to consider a few things. Your financial goals. You might want to save for a down payment on a house or for your child's college education, or you might want to build wealth for retirement. Once you have clear goals in mind, you can start to create a plan to achieve them. Next, determine your time horizon. If you have a long-term goal, such as retirement, you may be willing to take on more risk because you have a longer time horizon to ride out market fluctuations. If you have a short-term goal, such as buying a house in the next 5 years, you may need to be more conservative because you have a shorter time horizon. Next, assess your risk tolerance. This is the level of volatility or uncertainty that you're comfortable with when it comes to your investments. Some investors are willing to take on more risk in pursuit of higher returns, while others prefer a more conservative approach. You can ask yourself questions such as, how old are you? How would you feel if your investments lost money? How much of a loss are you willing to tolerate? These things should be reviewed regularly to ensure that you stay on track with your financial strategy. It's important to remember that investing in the stock market comes with some level of risk, but by setting clear financial goals, determining your risk tolerance, and creating a diversified portfolio, you can better manage the risk and increase your chances of achieving your investment goals. Personally, I've had success investing in stocks with a long-term view. This strategy aims to grow wealth over long term by buying and holding stocks, typically several years or more. This strategy is based on the idea that over the long term, stock markets tend to rise as the overall economy gets bigger. Here are some principles that I use when investing in stocks. Diversifying the portfolio by investing in a mix of different stocks, sectors, and geographic regions. This can help to reduce risk and increase returns over time. Long-term investing requires patience and a willingness to ride out short-term market fluctuations, to stay invested and not to make impulsive decisions based on short-term market movements. One of the key benefits of long-term investing in stocks is the power of compounding. This is the process where dividends and capital gains earned on the stocks are reinvested, earning more dividends and capital gains over time. Long-term investors can benefit from lower trading costs and can be more tax efficient, as it allows investors to take advantage of long-term capital gains rates, which are typically lower than taxes on more frequent trading. Before you can invest in stocks, you'll need to open a brokerage account. You can choose between a traditional brokerage account or a robo-advisor, depending on your preferences and needs. The traditional brokerage account gives you the flexibility to buy and sell stocks on your own, while a robo-advisor uses algorithm-based technology to manage your portfolio for you. Robinhood and Fidelity are both popular options for traditional brokerage accounts, but they have some key differences. Robinhood is a commission-free trading platform that allows users to buy and sell stocks, options, and exchange traded funds or ETFs without paying any trading fees. The platform is known for its user-friendly interface and its popularity among younger, first-time investors. Fidelity, on the other hand, is a full-service brokerage firm with a wide range of investment options. It also offers research and educational resources, as well as financial planning and advisory services. However, it charges commission fees. Now that you have a brokerage account, it's time to start building your portfolio. But let's cover one more important principle. Diversification is a key principle of investing that aims to spread your money across different types of investments to minimize the risk of loss. There are several different ways to diversify your investments, including 1. Asset allocation. This involves spreading your money across different asset classes such as stocks, property, bonds, and cash. Each asset class has its own set of risks and returns, so by spreading your money across different classes, you can reduce the volatility of your portfolio. 2. Geographic diversification. Investing in companies and funds that are based in different countries can help diversify your portfolio, as different economies and political environments can have a big impact on the performance of investments. 3. Sector diversification. Investing in companies from different industries can also help reduce risk. For example, if you invest in a technology company and that industry is not doing well, then it will not affect your portfolio as much as it would if all your investments were in the technology sector. 4. Diversification by market capitalization. Investing in companies of different market capitalization, such as small cap, mid cap, and large cap companies, can help diversify your portfolio, as different market capitalization companies have different risk and return characteristics. It's important to note that diversification does not guarantee a profit or protect against loss, but it can help to reduce the overall volatility of your portfolio by spreading your investments across different types of asset sectors and geographies. If you are new to stock investing, don't have the time for research, or you don't have a lot of money to invest, don't worry, you can still get started and get all the benefits of diversification. Mutual funds and exchange-traded funds, or ETFs, are both types of investment vehicles that allow you to invest in a diversified portfolio of stocks, bonds, and other securities without having to pick and choose individual investments. They also are great when starting out, as they allow you to take advantage of one of the most powerful concepts in investing: dollar cost averaging. Dollar cost averaging is a simple but powerful concept, whereby instead of buying a large number of shares, ETFs, or mutual funds all at once, you purchase smaller amounts at regular intervals over a period of time, regardless of the price. Dollar cost averaging has several benefits. It reduces the emotional impact of buying at the wrong time. It helps investors avoid the common mistake of trying to time the market. It can lower the overall cost of investing by buying more shares when the price is low and fewer shares when the price is high. A great strategy if you are just starting out is to allow a mutual fund to auto-debit your account around the time you get paid your salary. You will be dollar cost averaging without even thinking about it, and over time building a nice investment. Be patient and disciplined. Investing in the stock market is a long-term game, and it's important to maintain a disciplined approach and not get swayed by short-term fluctuations. Once you are ready to start investing in individual stocks, research is the best way to get good results. When starting out, this will be a bit daunting, but stick with it and it will become easier over time. Start by reviewing the financial statements of the companies you're interested in investing in. Look at the balance sheet, income statement, and cash flow statement to get a sense of the company's financial health. Pay attention to key metrics such as revenue growth, net income, and return on equity. Look at the company's management team and board of directors. Research their backgrounds and track records. Look for experienced and successful leaders who have a track record of growing a business. Analyze the company's industry and competitors. Understand the trends and challenges that are impacting the industry and how the company is positioned relative to its competitors. Analyze the company's growth prospects by looking at its historical performance, current trends, and future plans. Look for companies that have a strong competitive advantage and a clear path to growth. Stay up to date on the company's news and developments by monitoring news articles, press releases, and analyst reports. Look for positive developments such as new products or partnerships that could drive growth. It's important to remember that researching potential stock investments takes time and effort, but it can help you make more informed decisions and increase your chances of achieving your investment goals. That concludes our video on stock investing for beginners. Remember, investing in stocks can be a great way to build wealth over time, but it's important to educate yourself, set financial goals, and develop a disciplined approach. Good luck on your investing journey.